Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I'm going to go over 5 companies that are undervalued. But also there is a bit of a twist. This time we're not using what we normally use, which is basically loads of different websites to get our information. This time we're going to use our research is mainly based on Seeking Alpha. Seeking Alpha has a section in their website called Quant rating. That's their own software that rates based on the attributes, characteristics, or metrics that they use to find undervalued stocks. They also have Seeking Alpha contributors, people that have been investing for quite some time, and they give you their ratings, as well, of course, the Wall Street rating. So those are the 3 things they give you. So I'm going to give you 5 companies that they are right now recommending, their systems recommending, and I will tell you exactly why I think this is worth watching. So just give me one couple of minutes and then I will explain how their system works. But before we do this, it takes a lot of time and research to put these things together, and I really genuinely would appreciate if you can like the videos. There's 2-part videos. This one is all about dividend paying companies and the next one is high growth companies. So I've got 2 videos back to back, InshaAllah, that you can watch and InshaAllah gain something from. And of course, if you're interested in that side of things, subscribe to the channel and of course open up that notification so you don't miss anything that we post. As well as that, of course, you join us in the Patreon account where you get access to all the buys and sales, portfolio updates, dividend trackers. You got the dividend calendar spreadsheets, you've got the watch list and all the other things that we normally talk about, as well as the Discord access, inshallah. Right, let's get to this. This is the Quant performance system. So they have Seeking Alpha's Quant performance system. And check this out. For the last 10 years, if you invested £10,000 in some of the companies they have recommended, this system has recommended, right now you would be seeing here a total return of $222,000 closer to $223,000. Okay. Total return in the S&P 500 in that time was $177,288. Now that's basically average annualized return. Annualized meaning basically you would have made 25% every single year for the last 10 years. That's absolutely amazing. So what I've done now is I've looked at this system and looked at the companies they've recommended. So let me give you a bit more information. It says how our Quant system works. Seeking Alpha is a strong buy. So these are the companies that we're looking at today. Quant ratings are the result of powerful computer processing and our special quantum mental analysis. From nearly all US securities, our quant algorithm picks stocks with the strongest collective value, growth, profitability, EPS revision, and price momentum matrix, okay, against the peers. These attributes are assigned grades that are then weighted to maximize the predictive value. The best stocks are awarded a strong buy rating. And they talk about basically what they've done in the last 10 years. And they give you a bit more information on that since 2018, blah, blah, blah. But it's really interesting. So I'm not saying this is going to guarantee total returns of this sort of a thing, because that's in the past. But this is what they're talking about. This basically they're saying based on their current, based on their system, potentially this is what you can get. 25% is a lot. So I'm going to share with you guys now 5 companies that are strong buys based on their system, okay, and then either strong buy or buy. And I will give you also, next video will be also high growth companies. These are dividend paying companies, okay. And the first one they're talking about is Gilead Sciences. This is one of the pharmaceutical companies. It has 107 billion market cap, has a wide economic moat. Current price is $85. Dividend yield of 3.58% right now, which is quite nice. The payout ratio is 25%. Latest increase was 2.7%. 5-year growth rate of 5%, 7%. Dividend streak for 7 years. So they have increased that dividend for 7 years without cut. Annual payout of $3. Safety 70%, 25%. Profit margin 27%, return on equity, free cash flow 7.8 right now. Total return in the last 10 years we're looking at about 3%. Growth estimate next year is about 7%. Growth estimate after that is about 4% every single year. According to Morningstar, is 13% discounted and fairly valued according to basically right now is their fair value price is $97. So that's based on this. Let me show you now based on Seeking Alpha. As you can see here, Quant is actually saying it's a strong buy, 4.93. The highest they give normally is 5, ratings of 5. So there you go, it's almost there touching, right? Analyst here is saying also it's a buy, 3.66, and basically Wall Street saying 3.78. Okay, their price target for this company is $90. Right now it's about 5% down from that. And then you get these people who actually set different prices. And as you can see, basically based on what they've recommended, and as well as that, if we look at Quant, for example, it gives you the information basically where they recommended the price. So price right now is basically 80. That's basically where we are right now. And then it gives you a little bit of information about the rest. Okay, so as you can see, they have been recommending this for a while. So since actually it's the only reason they've changed their mind. That's interesting. So there you go. That's the first company we wanted to look at today. The next one is Williams-Sonoma, 13 billion market cap. It has a none in terms of moat side of it, $202 per share, dividend yield of 1.7, payout ratio 23%, latest increase 15%, 5-year growth rate of 15%, and then dividend streak of 13 years. $3.60 is what you will get. Safety 80%, which is quite nice. Profit margin of 12% almost. Return on equity absolutely huge, 59%. Free cash flow of 851 million. Total return in the last 10 years about 15%. Growth estimate is 1%, then 10% every year after that. Fairly valued according to Morningstar, $205 per share is where they think the price should be. Now if we look at Seeking Alpha, as you can see, it's a strong buy. So if we go on here, you could see, let me have a look where the prices are when it comes. Okay, so it basically they're saying it's downside of about 11% Wall Street side of things. And as you can see here, they have been recommending this for quite some time now. Okay, so since, let me see, it's been a strong buy since June. Wow. Okay, so since September of 2023 is actually been, they've been saying it has been basically a buy since September. It's a strong buy, sorry. There you go. So that's the second company that I want to share with you guys today from that system. The next one is EOG Resources, the company that we talked about recently. It's oil company, $65 billion. Market cap, narrow economic moat, $110 per share right now. Dividend yield of 4.6. Which is quite nice. Payout ratio only 28%. Latest increase was 10%, and the 5-year growth rate of 36%, which is absolutely huge. 5 years of increase in that dividend. $3.64 is what you get for every share of that company that you own. 82% in terms of safety. Profit margin 33%. Return on equity 30%. Free cash flow 5.6% right now. $1 billion, sorry. Total return in the last 10 years 5%. Growth estimate next year is about 5%, and then minus 1% after that for the next 5 years. Fairly value right now $132 per share is where the prices should be according to Morningstar. Let's have a look at what Seeking Alpha is saying. And as you can see here, it's a strong buy again. Wall Street is saying it's a buy, as well as Seeking Alpha analysts. All of them is a buy. So if we check Wall Street, see what they're saying in terms of buy. So 29% upside from now, $142 per share is where they think the price should be. Let's go back to Quant ratings and see. Okay, so they've started recommending since December basically. So they started saying it's a stronger buy since then. So there you go. That's the third company. The fourth company that we're going to look at today is Procter & Gamble. This is a company that we talked about recently, and the only one that I own in this portfolio. So $353 billion wide economic moat, almost $150 per share right now. And dividend yield of 2.56, payout ratio is 60%. Latest increase was 3%, 6% in the last 5 years, 67 years of increase in that dividend. So they are dividend king. Safety right now is $3.76 is what you will get annually. 99% in terms of safety. Profit margin, return equity, absolutely amazing. $14.5 billion of free cash flow right now, 8% growth in the last 10 years. Growth estimate for the next year is 8%, then 8% every year after that, which is wonderful. For me, this is what I expected this type of business to give me. And the 9% premium right now, according to Morningstar, $138 per share is where they think the price should be. And right now it's $149. And looking at this, is a strong buy again, 4.85 right now. And according to Seeking Alpha Analysis, as a hold. Wall Street is actually staying as a hold. Let's see how long they've been recommending this. So since July, basically, of this year, they have been recommending this company. No, since December, they have been recommending this. So which is quite nice to see. Okay, so right now it's still a strong buy, because if you look at it, it's 4.85. Let's have a look at what Wall Street is saying in terms of price wise. I did a whole video recently, so if you want to see a bit more details about the company, go and watch that. Almost 10% upside from where we are now. $164 per share is where they think the price should be. And the final company we're going to talk about today is a Caterpillar, 146 billion market cap, wide economic moat, $277 per share right now, 1.79 dividend yield, 25% payout ratio. Latest increase was 8%, 5-year growth rate of 9%, in dividend streak of 29 years. So they are dividend aristocrat. Annual payout $5.20. Safety was 93%. Profit margin 13%. Return on equity 50%, which is quite nice. $8.6 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 13%. Growth estimate for next year is about -1%. And then growth estimate for the next 5 years per annum is 13%. Right now is premium, according to Morningstar, 28%. $229 per share is where they think the price should be. Let's have a look at what Seeking Alpha is saying about this company. I'm going to show you in a second the entire companies, some of the companies they have on this list that we haven't spoken about. But yeah, as you can see, 4.8% right now, strong buy. Wall Street is actually saying as a hold. Seeking Alpha Analysis is actually saying as a buy. So if we look at Wall Street and see their price target, as you can see, it's just basically fairly valued at the moment. And if we go back to Quant, just see how long they have been recommending this. It's been quite some time. Wow. So since October, okay, September. How long have they? Okay, so they've been recommending basically this stock for quite some time now, probably since the summer. So that's the second company that I wanted to share with you. The last company I wanted to share with you guys today. So if you go back here, you can see basically you can pause the video and have a quick look. If you're interested in any of these companies, I will definitely do a lot more research to find out about the companies. Remember, we can say, okay, this is what they're saying and this is what they recommend. But of course, you're going to have to do your own research, find out a bit more information. In terms of Sharia compliance side of things, there's no issues with these companies. Okay, Gilead and as well as Caterpillar has a slightly interest-bearing debt, and the rest of them should be fairly okay. So that's the 5 companies I wanted to share with you guys. As always, if you like this type of content, like I said, it takes a lot of time to put these videos together. I would really appreciate it. I'm now going to do the second video, inshallah, and I'll release that with it. So at least you have both, basically dividend paying companies that are very stable, has excellent free cash flow and so on, growing their businesses well and so on. But the next ones will be high growth companies, so they might not have a lot of free cash flow. They might not have basically they have the growth side of things, but they might not have the PEs and all of that stuff. But I will share that with you guys, inshallah. Have a wonderful day. Assalamu Alaikum.